want to get to Chicago, get an early look at trading there. Trey Knippa from Lotus Brokerage at the CME Group joins us right now. You know, Trey, Japan also on your radar? Why is that?
Well, I guess this is some financial news that a lot of investors and a lot of traders might be overlooking, but the Japanese government bond 10-year futures have taken a pretty good hit over the last couple of nights. And just you have a regular guest, you have Kyle Bass here on all the time who talks about the Japanese government bond market, so I won't go over what he says, but the point here is that a small increase in rates for Japan, given how much their debt service cost as a percentage of their tax revenue, is just absolutely crippling them, or could cripple them if you see any increase in rate. So as I see rates, granted, a move from 1% to 1.1, that's not a big a deal. But considering that the rate on the 10-year bond there hasn't been above 2% since 1997, it doesn't take much of a move at all before you put Japan in some real financial straits. I'm not talking about a move like we've seen in Italy from 5 and the market jumps, but that kind of begs the question here, does a rate increase cause a sovereign debt crisis, or does a sovereign debt crisis cause a rate increase? So you've got to watch really closely there.
Yep. No, I'm glad you pointed it out. You know, an IMF report actually available online just came out. Page 17, are Japan's imbalances a problem? Something that, in fact, my friend Kyle directed me to as well. Talking about that very problem, Trey, you know, there are 2% of GDP at this interest rate. An increase of 100 basis points would double the percent of GDP going to interest payments. It's a concern or not?
Absolutely.
It isn't right now.
I want to ask Tony. Let's go to you.
Sorry.
You have some thoughts. That's all right, Trey.
Okay, it isn't right now. What's probably happening is just reflects the flight to quality to the U.S. Treasury market, because the Treasuries have a special place in the world because the dollar is the reserve currency. And Japan can still self-finance. It has a current account surplus. We still buy more stuff from Japan than they buy from us, and us meaning the world. So they're able to take in capital to finance the deficits. This will go on for several more years. And remember as well, they have $1 trillion of international reserves, money in the bank. Before that's drawn down, it won't be a problem. And it's not even at the point of being drawn down. Not until the current account surplus, the big trade surplus, goes away. And it may be several years away before that happens. So it's not on the immediate radar. It's several years out.
These things can creep up on you quite
They can creep up, but the current account surplus is the
same thing about Europe.
Absolutely.
Trey, thanks for your insights. Appreciate it. Trey Knippa, have you join us.